Treasury yields hit a 3-year low and did see a modest bounce higher after, but the trend remains the same. Stubbornly low yields as the uncertainty of trade, and the uncertainty of the U.S. economy, or whether it is something from the Fed, continues to plague the market. We see equities trade higher, we see equities move lower, but the bond market has seen steadily price move higher, steadily yields move lower, going all the way back to March. And I think at this point, until there's clarity on the trade front, you aren't going to see really any shift in expectations, any shift in trade. We're seeing actually greater demand for auctions at these lower yields, which was a bit of a surprise. And again, I think that's going to continue as the bond market is really telling you the macro story, whereas the equities tell you the day-to-days on how any headlines are interpreted. And if you look at market volatility, the MOVE index is holding near its highs from 2016, those mid-2016 highs. And what could have happened in mid-2016 that would have given the market a little volatility? Well, you had the Brexit announcement followed by the Trump presidential election. And those two things really are what posted the highest falls we've seen in quite some time. And we are at those levels right now as we wait for some resolution with China, as we wait for the Fed next month to come out. Are they going to cut 25 or 50? And the demand that we're seeing for treasuries, for high quality paper, continues to go through the roof. So right now yields, while we may expect a little bit of a relief sell-off in treasuries, we aren't getting it, and if we do, it's very short-lived. Lastly, we look ahead. We have some data coming out. We have the Fed coming out. We have a number of events that could happen, not in the moment, but certainly down the road. This week we get the revision to GDP. It will show continued strength in the economy. We get the PCE data coming out Friday. That will, again, nothing is going to knock the market off its rails. However, if we look ahead into September, yeah, we have an FOMC meeting that has now become the new it moment. Will the Fed cut more aggressively? Will they use quantitative easing? Will they do none of the above? And at this point, it's very unclear because we're getting a lot of different themes from different Fed speakers, which have been sort of throwing wrenches into what has historically been a very clear message from the Fed, whether they're going to be raising or cutting rates at any given meeting. So right now the bond market seems very much on an island on its own. It remains stubbornly moving towards lower yields, but if a Fed can come out and show they're not going to be as aggressively cutting or aggressively adding to any quantitative easing program, maybe that may be the reversal the bond market needs. It's unlikely at this point that the Fed wants to add more volatility to the market. However, they also don't want to feed the market any information that they're not going to follow through on. So right now the market pricing in a 25 basis point cut, possibility of maybe some asset purchases out there, but that has not been confirmed, and I doubt that we'll see an aggressive Fed at September. They'll give us a message, I think, at that point that will give the market a little time to digest, and then maybe in December would act if needed, if inflation, if growth, and if this global trade doesn't settle. They may need to act more aggressively later in the year, but I don't see it happening in September.